Well, we're getting some news right now from the FDIC on deposit insurance. Let's go to Leslie Picker on that. Leslie.
Hey, Sarah, we know that protecting the uninsured depositors amid the failures of Silicon Valley Bank and Signature Bank burned a sizable hole in the FDIC's deposit insurance fund. And the FDIC now out with a proposed plan that would have the biggest banks with the most uninsured deposits footing most of that bill. The FDIC is proposing to collect a special assessment at an annual rate of about 12.5 basis points over 8 quarters beginning in 2024. The rate was derived from estimates that the 2 March bank failures cost an estimated $15.8 billion to protect uninsured depositors. The FDIC says almost all of the special assessment will be covered by the biggest banks, which, according to the FDIC, benefited the most from the systemic risk determination. 113 banks will be subject to the assessment, with banks whose assets are greater than $50 billion paying 95% of it. The special assessment rate excludes the first $5 billion in uninsured deposits, so the way each bank calculates how much it owes is by taking the amount of uninsured deposits at the end of 2022 minus $5 billion times 0.00125. So I just did some kind of quick rough math looking at JP Morgan, for example. Their 10K showed uninsured deposits were about 1.4 trillion at the end of 2022. Applying that logic as laid out by these proposed plans, JP Morgan could be looking at a rate of about 1.7 billion for this fund. Now, the FDIC said it studied whether banks could absorb this rate and said that assuming it's collected, it's pulled forward in 1 quarter only, banks subjected to the assessment would see an average reduction in net income of 17.5%. So somewhat material to margins here. The FDIC is set to vote on whether to issue this proposal at a meeting that began a few minutes ago. If so, it goes into a public comment period. So not set in stone, but some sizable numbers we're talking about here, guys.
Leslie, this was expected, right? We knew that the big banks were going to have to be paying for this. I think the question from here is it going to go even farther? What are they going to do about the rest of the uninsured deposits in the system?
Yeah. It's a great question, Sarah. We did know this. It's part of the FDIC's charter, essentially, to have, some sort of a rate paid by the banks that contribute to the fund to cover these types of events. The question, I think, looking forward is whether the systemic risk exception will be used in cases if there is, future failures. And I think that's the big question mark. And as we look at the way that this proposed plan is laid out, it would be payable over 8 quarters. Well, by the time this happens, will we be through much of the turmoil that we've seen, or will we need to kind of push this out further to see if those estimates at $15.8 billion that they're looking at in terms of a gap to the insurance fund, what does that look like at the beginning of 2024, especially as this turmoil continues? Obviously, those are estimates right now. They change all the time. There are still various assets in receivership that have yet to be unwound. And so those numbers are kind of a moving target there. But obviously, as this unfolds, things could change. And so I think that's the big question here.